Investing in real estate comes with quite a few tax advantages, all while building equity in an appreciating asset that is generating income. Tip number 1, hire a tax strategist. First up, make sure you have someone on your team who is knowledgeable about real estate tax law and can help you formulate a long-term tax strategy that matches your goals. You shouldn't be looking for just any old CPA. Instead, you'll want to find a specialist, someone who has experience helping specifically real estate clients. This person should be able to do more than just file taxes or give you a simple bookkeeping advice. They should offer financial advice and services to help you from everything from entity structuring to navigating the complexities of depreciation schedules, 1031 exchanges, cost segregation studies, etc. Your goal is to minimize taxes, not just for this year, but for the long-term wealth development. And the right advice can and should pay for itself many times over. We recommend the real estate CPA, Brandon Hall and Thomas Castelli's team. Check out www.therealestatecpa.com for a great real estate CPA team. Tip number 2. Be a direct investor. By this, we mean you should materially participate in the operation of your real estate business. While it will likely still only qualify as passive income, if you are a direct investor who materially participates, then you can take advantage of tax deductions and maximize your tax write-offs ultimately. Material participation can take a variety of forms, from finding tenants to managing your rental property finances, but it has to be ongoing and significant. Work not done by the owner is then not counted towards material participation hours, nor is it the time spent commuting. So you want to discuss this with a CPA and test whether your material participation actually helps you to achieve the status that you're looking for. Tip number 3, use cost segregation studies. If you've been following our channel, you should already be pretty familiar with the benefits of depreciation in real estate. And because this essentially allows you to depreciate the valuation or the value of your real estate investments over what the IRS deems its useful life, which is typically 27.5 years for residential tenants and 39 for commercial. However, not everyone knows that you can accelerate this using a cost segregation study. This allows you to split out the value of non-fixed fittings from the value of the property and depreciate them over a shorter period of time. This means you can maximize the amount of depreciation you can claim in the early years of owning a property, which can essentially help boost cash flow and help you pay off debt, allowing you to build equity and scale your portfolio a lot faster. This isn't the right strategy for every situation, so again, important to talk to a real estate specific CPA to discuss how it will work and whether it's the right strategy for your long-term financial goals. Tip number 4, claim every tax deduction. One of the main benefits of being a real estate investor is the ability to deduct your operating expenses from your rental income, thus reducing your overall tax liability. To do this, you should familiarize yourself with the IRS rental property expense categories, which is typically found on the Schedule E, and making sure that you have the right systems in place to accurately record and reconcile your income and expenses throughout the year is just going to help you do that for tax time. You don't want to miss out on expenses because you've forgotten them or you've lost receipts. And the easiest way to prevent that from happening is to utilize a purpose-built software like Landlord Studio. With Landlord Studio, you can scan those receipts in real time, connect your bank accounts to reconcile transactions with a tap or a click, and automate the entire rent collection and income tracking expense process. And at the end of the year, you can simply just run a Schedule E report and share it with your CPA. Tip number 5, refinance and reinvest tax-free. Leveraging your existing equity can be a great way to increase income without increasing tax liability. So refinancing allows you to free up equity in an existing property without selling it and then incurring capital gains tax, meaning you can then reinvest that full amount into property improvements or even a new property to expand your portfolio. Tip number 6, utilize the 1031 exchange method. Another way to defer capital gains tax is to use a 1031 exchange. This allows you to sell your property without paying taxes as long as you reinvest the proceeds in a like-kind property within the time limit specified by the IRS. Like-kind property means a property in the same asset class. You can't, for example, exchange for a commercial property for a residential one, or exchange a rental for a private residence. 1031 exchanges can be quite complex, so make sure you speak with a CPA or a specialist about doing that. Tip number 7, become a qualified real estate professional. When you qualify for a real estate professional status, the passive loss limitations are removed. This means you can deduct your real estate losses against other income, for example, W-2 income. It also means you won't be limited to $25,000 of losses per year. If you have a substantial portfolio, then qualifying for real estate professional status could definitely help you reduce your tax bill. However, qualifying for the status is quite difficult, with investors needing to spend at least 750 hours materially participating in the real estate related activity. Typically, you won't be able to do this with a W-2 income job, so you'll need to become a full-time real estate investor to qualify for this. Tip number 8, use self-directed IRAs. Leveraging self-directed IRAs is the best way to invest tax advantage retirement funds in real property. So you can own a wide range of property types in a self-directed IRA, including land, single and multi-family homes, international property, boat docks, commercial properties, and more. As a self-directed IRA, you will need to find a custodian, a company to safeguard your account and enforce IRS regulations in order to hold these different types of assets. There are a lot of rules around governing everything from property ownership and usage to how you cover expenses and take profits. And inexperienced investors can easily run into lots of issues. So it's important to do your research and talk with a qualified professional before exploring that avenue. Tip number 9, step up in basis. Buying and holding real estate assets is a tried and tested strategy for building generational wealth. And with the step-up basis, you can completely eliminate capital gains tax. The step-up basis provision adjusts the value or cost basis of an inherited property or asset when it is passed on after death. This eliminates the capital gain that's occurred between the original purchase of the asset and the heir's acquisition, reducing the heir's tax liability. Again, if you want to know more about that, speak with a qualified real estate professional CPA, like the realestatecpas.com. And a bonus tip is leveraging property management and accounting software. Real estate investing is amazing for tax savings, but to make the most of these savings, you need to use tools and knowledge to accurately track all the tax deductions and keep detailed records and streamline the property management process whilst you're doing this. This is where Landlord Studio comes into play. Streamlining income and expense tracking can be easily done with our automated reconciliation and a smart receipt scanner on the app, which then allows you to instantly generate accountant-approved reports for detailed insights into your portfolio finances. You can even use Landlord Studio to collect rent online, screen tenants, create rental listings, and manage the property maintenance as well. Landlord Studio is free up to 3 properties, and if you go over that, there's a monthly subscription, and the best part about that is tax deductible, as it is a business expense. So all of these tax saving strategies can be employed to help you maximize your real estate return on investment and ultimately grow your wealth. However, to fully take advantage of them, it's really important to have the tools like Landlord Studio and the knowledge from a good financial or CPA who are going to help you navigate the complexities of these strategies so you can reduce your tax liability, scale your portfolio, and achieve your financial goals. If you found this information valuable, hit the like button below, subscribe to our channel for more insights, and share this video with your fellow landlord friends. And of course, if you have any questions or comments, please leave them in the comment section below. And until next time, have a great day. Cheers.